This is episode 270 of Zen and the Art of Real Estate Investing with my guest, Mike Zane. Mike is the founder and managing partner at Lexcraft Advisors. They are a CFO services firm that supports middle market real estate investment funds and syndication groups. He also has prior experience at PricewaterhouseCoopers and in the real estate finance business at JP Morgan Chase. Mike, welcome to the show.
Thank you, Jonathan. It's good to be here.
Yep. You know where I'm going to start. It's not going to be about real estate. The audience is now listening to the two most monotone people in the world. We are going to set this place on fire.
Let's do it. I'm excited.
Yeah. Well, it's good to have you here. And I'm really interested in the background to how you got to this part of syndication. So tell us your story of why real estate after your degrees were really in business and economics and how you got into the back end of syndications.
Yeah, that's a good question. So you're right. I mean, I've got degrees in mostly finance, have an accounting degree at the grad level, but I ended up almost just through happenstance at working at JP Morgan. I was in the real estate finance group there. So that was kind of the first professional foray into real estate. I mean, this is going back 12, 13 years at this point.
Yeah.
So kind of cut my teeth there, got to understand the finance side of real estate in a way that, you're not going to really learn in school or anything. It was more that hands-on approach, and learned some pretty solid, analytical skills back there, kind of the technical side of it. So that was, in hindsight, very fortunate, and I'm lucky to have gone through that. That kind of translated into a role that I had at PwC for a good 5 years or so, where I was kind of straddling two different sides of the business. So on the one hand, I was doing strategy and advisory work for major finance companies. A lot of it was focused around the commercial lending aspect and standing up different in-house ops programs at some of these companies. And then the other side of what I was doing there was on the audit side, so very accounting heavy stuff. And the clients that I was working with there, again, were in that commercial lending space. There's some esoteric assets in the commercial real estate finance field. We were building financial models to kind of check the valuation of some of these odd asset groups that you don't hear too much about. But so that was kind of the hands-on accounting side of my professional background. And so the shops we were working with back then, I mean, these were some of the largest private equity firms, banks, what have you, out there. And I vividly remember sitting, I think I was in Minneapolis one day at a client, and I remember sitting down and kind of thinking to myself over lunch one day, I think there's an opportunity to kind of take what I'm doing here and kind of this skill set and this interest that I have and scale it down. And really the thing that you learn with management consulting is that it's all about the relationships.
Yeah.
And so if we kind of translate this relationship-centric viewpoint into this middle market of real estate, I just couldn't disprove to myself that anybody was doing this. So it was in 2021, made the jump, started the business, was able to kind of through luck grab a couple of sort of smaller clients to start. And, here we are. It's been 4 going on 5 years.
Based on your experience, do you think it's an actual experience issue for those people who are running those funds? Because from what I've seen, when the initial pro forma or docs don't look good, it usually just means they don't have the operational experience to make it deliver the way that I'd like. And then, of course, the people who go into that fund, if it's a first or second, the monthly deliverables are not going to look what they expect, maybe. Or maybe they don't know, but I think that can be a big letdown.
Yeah, I mean, our client base kind of splits into two groups. We do have this niche where we help first time fund sponsors or equity raisers kind of stand up their platform.
Yeah.
So, in a case like that, I think what you're saying is spot on. The experience might just not be there to
Yeah.
provide that great investor experience that we all want. Uh, on the other side of our business, where we're working with sponsors that maybe they're 10 or 12 syndicated deals in, or maybe this is their second or third fund, uh, they typically know what good looks like and what bad looks like. It's really a matter of, do they have the operational side of their business in order in a way that can kind of deliver on that. So in those cases, it's more about us kind of working with the sponsor to say, hey, this is what we think. What do you think? Kind of put it together and then build out the platform to be what we all kind of collectively think it should look like.
When you get the pitch deck, like, it's actually too much for, yeah, even for someone who's
Yeah.
been in it for so long. It's just there's so much in there. You really need to know where to look. Is there something in a pitch deck that you would tell a first time LP, like, hey, focus on these few things if you just want to kind of get your general overview when it just looks like, they've fallen onto an accountant spreadsheet hell?
Yeah. Yeah. So I think that most of the collateral that we put together for first timers or for emerging sponsors, it focuses on the strategic, uh, kind of like the strategy behind what they're doing.
Yeah, yeah.
So, we have clients who maybe they're geographically focused. Maybe they know a particular market really well. We're probably trying to shine a light on that. Because even if the track record's not that deep, we can legitimately go out to the prospective investor base and let them know, hey, we've been, working in XYZ city for 10 years in different capacities. Um, we know it like the back of our hand, et cetera, et cetera. So I think that's a great way to kind of break in from that standpoint. So it's stuff like that we try to focus on. I think every piece of pitch deck collateral that we produce does have some kind of pro forma view.
Yeah.
So we're not really going to send something out to market without some kind of financials in it. Now, to what level of detail do those financials need to go? That's probably the core question. And I think that gets back to what we talked about before. Who's your target profile?
Based on your experience of what you've seen and who you're managing, are you finding any of the syndication asset classes doing better in today's current environment than others?
I would say anecdotally, uh, we've seen certain industrial asset classes do quite well,
Yeah.
and especially in certain geographies where there, for whatever reason, there seem to be supply constraints. Um,
The cost of construction is lower on that than obviously multifamily or even, well, I mean, it's similar to self storage in some ways, but even less for industrial.
yeah, I mean, I'm kind of getting outside my swim lane a little bit here, but from all the work that we do, I know there are certain markets where supply is constrained for reasons aside from cost. Maybe
Yeah.
it's red tape or regulatory or permitting or whatever it might be. It's kind of a city by city thing.
Yeah.
So, we have some clients who have sort of identified those places and have had good success acquiring existing stock in some of those cities. So
Yeah.
that's kind of an example of something that's worked well. I think if anybody out there is raising equity for a multifamily development right now, especially in like a tertiary market, that's hard.
Yeah.
We've heard that from quite a few of our clients.